The silver market just experienced something absolutely earth-shattering, and if you're not paying close attention to what happened beneath the surface, you're going to completely miss the significance of these recent developments that could reshape your entire investment strategy. Yes, everyone's talking about silver exploding past $82. Yes, social media is flooded with claims about runaway rallies and historic breakouts, but the real narrative, the one that could make or break portfolios, runs much deeper than celebratory headlines and vertical price charts. What we just witnessed wasn't simply another commodity price spike that traders will forget next week. This was a demonstration of raw market force that appears maybe once in a decade, powered by mechanics that most mainstream commentary completely overlooks or deliberately ignores. Before the collective excitement drowns out the meaningful signals that actually matter, you need comprehensive context that goes beyond surface-level analysis. Because understanding what's truly driving this movement matters far more than just watching numbers climb on a screen and celebrating temporary gains. The breakthrough above $82 represents way more than just another milestone to check off. It's a warning shot fired across the entire financial landscape, a signal that something fundamental has shifted. And while platforms across the investment universe broadcast moonshot theories and breakout validations that generate clicks and views, the surface-level price action is actually the least significant element of this entire equation. That's not an exaggeration. That's the uncomfortable truth most people refuse to acknowledge. Let me lay out exactly what actually unfolded in the past few trading sessions. First, Majestic Silver, trading under ticker symbol AG, just absolutely detonated upward by more than 20% across just 2 trading sessions. If you checked your financial feeds any time during the past 48 hours, you likely encountered the same tsunami of enthusiasm washing over investment communities, investors celebrating silver's long-awaited liberation from suppression, miners finally leading the charge after years of underperformance, the anticipated launch sequence initiating at last after so many false starts. The excitement is completely understandable and, frankly, justified on an emotional level. Countless investors have maintained silver positions through extended periods of sideways frustration that tested every ounce of their conviction, holding steady while global economic conditions grew increasingly strange and markets remained tightly wound like a coiled spring. Some have been positioned for years, literal years, enduring brutal tests of conviction, watching prices grind horizontally in soul-crushing consolidation patterns, questioning whether the anticipated move would ever materialize or if they'd been fooled by false prophets. So now, with silver not merely moving but absolutely ripping higher with the kind of violence that makes headlines, the emotional release is deafening across trading communities. Celebrations everywhere you look, people declaring they predicted this exact outcome and showing off their winning positions. The profound relief of finally witnessing real momentum after such long, painful patience that made many question their sanity. But here's the uncomfortable truth most people desperately resist hearing. The visible price movement that everyone's celebrating isn't actually the real story unfolding here. What's happening underneath the surface, in the hidden machinery of the silver market, is what truly matters for your financial future. Silver carries a long, brutal history of making investors feel absolutely brilliant for brief, intoxicating periods before correcting with such shocking violence that it completely erases the entire crowd's confidence and leaves carnage in its wake. The critical skill separating winners from losers is distinguishing what's genuinely sustainable from what's just noise, what represents real structural change versus what could still unwind catastrophically and destroy unprepared portfolios. That's where the real importance lies, and that's precisely where most online hype becomes dangerously misleading and potentially destructive to your wealth. Rather than joining the masses mindlessly shouting about vertical candlesticks and posting rocket emojis, let's systematically break down what actually carries weight in this situation. Imagine this analysis structured in 3 distinct layers that reveal increasingly important truths. The first layer represents the surface, price action, headlines, the statistics everyone repeats reflexively without any deeper consideration or critical thinking. The second layer contains the actual engine underneath, the massive transformation that just occurred within First Majestic's financial structure and its profound implications for the broader mining sector that most analysts are missing. The third layer, the one almost universally ignored by mainstream media, involves the structural mathematics supporting the long-term silver market, the supply-demand mechanics that will ultimately determine whether this movement arrived too late, too early, or is genuinely just beginning a multi-year expansion that could dwarf previous bull runs. Before we dive deeper into the shocking details, let me establish something as simply as possible. If you genuinely value clear, unfiltered analysis that cuts through both irrational hype and paralyzing panic, Make absolutely sure you're subscribed and actively following. The entire purpose of this breakdown is delivering brutal clarity that you won't find in sanitized mainstream coverage. Drop a comment indicating where you're watching from. It's always absolutely fascinating seeing how globally this community of serious investors extends across continents. If you haven't joined the WhatsApp community yet, you'll find the direct link below this breakdown. That's where real-time discussion continues between major videos and updates. I also share rapid-fire insights and breaking developments on X that don't always become full comprehensive breakdowns, but can give you crucial edge. With that foundation established, let's proceed into the shocking details. COMEX silver for February delivery concluded the week at an eye-watering $82.28 per ounce. That represents a weekly gain of $4.43, translating to 5.69% in just 5 trading days. But even that impressive figure doesn't come close to capturing the true intensity and violence of what actually occurred when you zoom in closer. Examine just the final 3 sessions alone, the period where things got truly explosive. Silver gained a staggering $8.84 in just 72 hours, over 12% movement in 3 trading days, 12% movement in a major commodity market. These aren't ordinary fluctuations that technical traders see regularly. They're not gentle upward drifts that suggest healthy consolidation. They represent the market transmitting an urgent message that something fundamental has changed in the underlying structure. Here's additional context that most observers and commentators completely overlook in their superficial analysis. Silver now stands nearly 183% higher than its 52-week low, almost triple the bottom price. It's sitting almost 150% elevated compared to this exact date 1 year ago, a gain that would be considered extraordinary in almost any asset class. It's more than 17% higher year-to-date alone, and we're barely into the year. Yet simultaneously, and this is the part that creates the tension, it still remains approximately 28.5% below the record high of $150.80 that was reached back in January during that spectacular spike. Consider carefully what that specific combination creates from a technical and psychological standpoint. A market that has nearly tripled from its absolute bottom, running with clear conviction and institutional participation, yet still sitting almost 30% beneath where it peaked just a few weeks earlier. That particular combination is enormously significant from a market structure perspective. It generates a very specific type of setup, one that's absolutely capable of producing massive, life-changing gains for those positioned correctly, or brutal whiplash and devastating losses for those who misunderstand the dynamics and get caught on the wrong side. If you're relatively new to following these markets, understand this fundamental principle. I'm not here promoting specific assets or trying to sell you something. I'm not here inducing irrational fear or promising unrealistic returns. I'm here providing the clearest possible perspective and honest analysis so you can think critically and independently rather than react emotionally to every headline. And genuine critical thinking demands absolute willingness to examine both sides of every argument, even when that directly contradicts your current bias or position. Markets respond to positioning, capital flows, shifting expectations, and genuine surprises, not to feelings, preferences, or wishful thinking. Now let's examine in detail what happened with First Majestic, because this is where the entire narrative fundamentally shifts from speculation to concrete reality. AG wasn't merely strong this week in relative terms. On Friday alone, it ranked as the #1 gainer among all companies carrying at least $10 billion in market capitalization, beating out thousands of competitors. It surged more than 11% in a single trading session, building explosively on top of an already impressive 9.65% rally the previous day, over 20% across just 2 sessions for a company of this size and liquidity. This wasn't some random meme stock squeeze orchestrated by retail traders or a momentum accident driven by algorithmic trading. Real, tangible, fundamental fuel powered this violent movement upward. First Majestic reported a transformation so dramatic it's almost difficult to believe. The company swung from a devastating net loss of $119 million in fiscal 2024 to a robust net profit of $211 million in fiscal 2025. That represents approximately a $300 million swing in profitability within just 12 months, a complete reversal of fortune. Let that staggering reality sink in for a moment. A mining company that was hemorrhaging over $100 million annually, suddenly generating well over $200 million in pure profit. This isn't accounting trickery or financial engineering. This is operational reality driven by price environment changes. The revenue side of their financial statement tells an even more extreme and shocking story. Total revenues more than doubled year over year, jumping from $560.6 million to an impressive $1.257 billion. This massive transformation was driven largely by a 47% increase in average realized silver prices across their production. The higher price environment didn't just help incrementally or provide marginal improvement, it completely rewired the entire company's financial performance from top to bottom. Focusing specifically on the fourth quarter alone reveals even more dramatic changes. Net income hit $105.2 million, completely reversing a painful $13.5 million loss from the equivalent quarter just 1 year prior. Quarterly revenues surged an absolutely staggering 169%, climbing from $172.3 million to $463.9 million in a single year. This isn't incremental improvement or gradual recovery. This represents a fundamentally different company operating in a fundamentally different price environment. Then came the announcement that really caught experienced investors' attention, the dividend declaration, an immediate payout of 0.008 tron per share for all shareholders of record as of February 27th, with payment scheduled for March 16th. And beginning in June 2026, the dividend policy shifts to a structure of 2% of net quarterly revenues distributed to shareholders. At first superficial glance, that percentage might appear relatively modest and unexciting to income-focused investors, but it signals something absolutely crucial that goes far beyond the immediate payout: genuine confidence from management. A mining company that was losing substantial money just 12 months ago now possesses sufficient financial strength and stability to return capital directly to shareholders on an ongoing basis. That single decision means management genuinely believes this elevated price environment isn't a temporary anomaly or lucky break that will quickly reverse. They're signaling they view it as durable and sustainable. Here's the much bigger picture that transcends the AG-specific story. This isn't just about one company's fortunate quarter or temporary windfall. It's a powerful signal broadcasting across the entire silver mining sector globally. When large, pure-play silver miners shift dramatically from barely surviving to generating substantial, consistent profits, you're not simply observing a fortunate quarter driven by luck. You're witnessing a genuine structural change in the economics of the entire industry. What's actively unfolding across the silver mining sector isn't isolated to one fortunate miner or one exceptional trading session. The fundamental shift is propagating outward systematically, and the deeper you examine the data, the clearer the unmistakable pattern becomes. When profitability appears seemingly overnight for companies that previously struggled just maintaining break-even operations, something significantly bigger is moving powerfully beneath the surface. This is precisely where people fixating solely on price candles and technical patterns get completely blindsided by reality. Because while short-term traders celebrate the immediate spike and post their winning screenshots, the underlying structural dynamics reveal precisely why this movement isn't random noise, and why casually dismissing it as temporary excitement could prove extremely costly to your portfolio. The mining companies are narrating their own powerful story now through their financial results and operational decisions. As silver prices push systematically upward, the companies most directly connected to physical extraction and production are demonstrating a specific type of financial acceleration and margin expansion that simply doesn't occur without genuine structural tightening in available supply combined with strengthening demand across multiple sectors. When a major miner's revenue literally explodes by hundreds of millions of dollars and the broader market barely processes the profound implications, you know that surface-level hype and noise has successfully distracted most participants from the underlying mathematical reality. The dramatic transformation in AG's earnings wasn't some fortunate accident or temporary lucky break. It directly reflected what happens when a commodity that's been systematically undervalued, artificially suppressed through various mechanisms, and largely ignored by mainstream investors, finally steps decisively into a price band that fully exposes the tremendous pressure that's been building inside the system for years, and the broader market is beginning to react and reposition accordingly. Whenever silver takes off explosively, many investors' immediate first instinct automatically assumes it's simply following gold's lead as it traditionally has. But current numbers and correlations paint a distinctly different picture. Silver is demonstrating clear independent momentum, driven powerfully by its own distinct fundamental catalysts that have nothing to do with gold's movement. Sophisticated investors actively tracking the gold-to-silver ratio are watching the compression pattern like meteorologists watch storm radar systems. Every single time silver accelerates faster than gold in percentage terms, Liquidity patterns shift dramatically, mining stock valuations shift, paper futures contracts shift, and eventually the entire ratio begins grinding systematically downward. That specific dynamic matters enormously because historically, silver delivers its most violent outperformance relative to gold, specifically when the ratio begins tightening from extremely elevated ranges where silver has been undervalued. But before people start shouting irrationally about parabolic runs to $200 or $300, it's critically important understanding precisely what this current phase actually means from a market cycle perspective. Silver surges often bring powerful waves of highly emotional trading behavior. Inexperienced people pile in frantically fearing they'll permanently miss the move. The genuinely dangerous part: silver rewards emotional behavior short-term with quick gains right before punishing it severely and violently with sudden reversals. That's exactly why maintaining absolute mental clarity and emotional discipline during these volatile phases is absolutely essential. You're witnessing violence in the candlestick patterns because the market is repricing expectations extremely rapidly. But that repricing process is occurring inside an environment already structurally strained by persistent supply deficits and steadily increasing industrial demand, especially concentrated in renewable energy technologies, photovoltaic solar panel manufacturing, and advanced electronics production. Meanwhile, mining companies globally operate in an increasingly difficult world where average ore grades continue declining systematically. Lower ore grades mean substantially more rock must be extracted and processed, producing the same number of ounces, raising operational costs substantially across the board. So when silver prices spike dramatically, the profitability swing becomes much sharper and more pronounced for mining companies than in most other industrial sectors. This is precisely why the financial recovery and transformation of companies like First Majestic carries even greater strategic importance than mainstream headlines suggest. It means silver has decisively entered a specific price bracket where mining operations become not just marginally profitable, but aggressively and substantially so. And when one major established miner suddenly posts hundreds of millions in positive income after bleeding losses for extended periods, it signals unmistakably that the entire industry's cost curve just shifted fundamentally. Simultaneously, the futures market is exhibiting specific behavioral patterns hinting at additional significant pressure building ahead. When spot prices push upward rapidly and mining stocks respond with even greater amplified force, the usual dynamic begins forming. Short sellers on the futures side face increasing pressure when margin calls suddenly appear. When concentrated silver shorts get genuinely squeezed by adverse price movement, available liquidity becomes pure rocket fuel. Forced covering dramatically inflates moves well beyond what retail traders could ever imagine possible. These squeezes can unfold slowly over weeks or explode suddenly over days. But when a physical supply deficit already exists structurally, they can escalate into truly dramatic repricing events. This is where most mainstream commentators fail completely in their analysis. They automatically assume recent surges are purely speculative or hype-driven because they only follow surface-level commentary and social media sentiment. But they systematically ignore that global silver demand reached new record highs driven substantially by industrial sectors, especially solar panel manufacturing, whose appetite for physical silver continues expanding annually at accelerating rates. Silver isn't only a store of wealth or inflation hedge for investors, it's simultaneously a critical industrial metal increasingly tied directly to energy transitions and digital infrastructure expansion. That means the fundamental floor beneath demand is substantially thicker and more resilient than in previous cycles. Now combine that structural demand growth with significant supply constraints. Primary silver mines globally aren't increasing output at anywhere near the pace matching demand growth trajectory. Many major producers deal continuously with declining ore quality, rising operational costs, and increasingly complex regulatory and permitting environments slowing expansions. And because substantial global silver production comes as a byproduct of mining other metals like copper, zinc, and lead, production cannot simply ramp up easily just because silver prices rise. It doesn't respond elastically to price signals the same way gold does. It's structurally constrained by its relationship with other metals' economics, making significant supply growth structurally limited regardless of price. All these converging forces create a specific setup where silver's trajectory absolutely cannot be judged solely by its recent dramatic rally. The true directional potential comes from deeply understanding how these multiple pressures interact systematically. Are we witnessing just another temporary excitement cycle that will fade? Absolutely not. The earnings reports, revenue shifts, cost curves, supply constraints, and industrial demand growth all point definitively to a market moving toward a major long-term structural recalibration. That recalibration process doesn't happen quietly or smoothly. It happens through a sequence of aggressive rallies, sharp pullbacks that shake confidence, consolidation periods, and renewed breakouts. Investors expecting a straight line higher will get violently shaken out. Those who properly analyze the underlying fundamental conditions will recognize that volatility is actually the bridge between old, outdated pricing models and new, realistic ones. And this is precisely the critical moment where that bridge begins forming. The powerful run toward $82 wasn't just another price spike to fade. It was the market finally acknowledging what miners have been signaling clearly for months. When profitability transforms this dramatically, when supply deficits stack persistently year after year, and when industrial consumption reaches levels that were completely unthinkable a decade ago, the market absolutely cannot stay at outdated valuations. The silver market is entering a distinct phase where price discovery becomes more intense than ever before in modern history. As we move forward, the inevitable pullbacks will severely test conviction, the explosive rallies will test discipline, and the long-term trajectory will test patience. But the unfolding story won't be controlled by emotions or sentiment. It will be controlled by mathematics, the mathematics of demand, the mathematics of supply, and the mathematics of the financial structures built around this metal. Primary silver mines are not expanding output in any meaningful way, and secondary production, which comes from mining other metals, cannot scale up just because silver prices rise. This built-in structural rigidity creates a severe bottleneck, and bottlenecks inevitably lead to repricing events. Meanwhile, the futures market experiences growing stress. When prices spike rapidly, short sellers face increased margin requirements. If they fail to meet those requirements, forced covering occurs. That covering becomes fuel for additional price movement. Miners feel these changes immediately. Rising silver prices push their margins higher, their cash flow strengthens, and their balance sheets improve. This attracts institutional investment, which then amplifies stock movements. But miners also face higher operating costs, labor constraints, and increasingly complex permitting environments. These pressures influence production timelines and shape expectations for future output. When these challenges collide with rising demand, the equation becomes simple. The market is structurally unprepared for sustained higher consumption. All these forces create a setup where silver's trajectory cannot be judged solely by its recent rally. The true direction comes from understanding how these pressures interact. The run toward $82 wasn't just a price spike, it was the market finally acknowledging what miners have been signaling for months. When profitability transforms this dramatically, when deficits stack year after year, and when industrial consumption reaches levels that were unthinkable a decade ago, the market can't stay at outdated valuations. The silver market is entering a phase where price discovery becomes more intense than ever. The months ahead will reveal how the market digests this new reality. But one thing is absolutely clear: the fundamentals that led to this breakout are not temporary. They are not speculative. They are not fabricated by hype influencers or chart chasers. They are the result of real-world conditions that have been tightening quietly until the pressure became impossible to ignore. And now that the pressure has broken the surface, the next chapters of this market will be shaped not by noise, but by absolute necessity. The question isn't whether silver continues higher. The question is whether you understand the underlying forces well enough to survive the volatility ahead and position accordingly.